If AI agents are out there earning money, investing on your behalf, and negotiating on your behalf, they're not going to work very well in a model that involves opening up a bank account and providing 2 forms of ID and waiting for 2 days for international bank transfers that cost 3% in FX fees. They need forms of money that move as fast as they do without any restrictions. Cheaper, faster movement of capital across borders, the ability to sell globally and settle instantly, or transact real estate and arrange funding within the same real-time process. That's where stablecoins fit in. It's just about money, but not as we know it. Today, I'm talking with Ryan Johnson-Hunt from New Money about why stablecoins still sound a bit dodgy to many people, how they plug into AI-driven finance, and the need behind non-US dollar denominated stablecoins. Before we start, please give this one a like if you enjoy it and subscribe while you're at it. Let's begin. What is a stablecoin?
Normally when we talk about tokens, digital tokens and crypto, there's the technology, but then there's also the volatility of speculation of the asset. So a stable coin is trying to get the best of both worlds, where the token itself runs on those same technology rails, so it's fast and cheap, but the ownership of that token represents a real dollar held somewhere by someone that's trusted and regulated. And so the idea is that that token is kind of pegs its value to that stable asset like a dollar.
So if you were thinking about this from an investment point of view, we're not necessarily looking at this as another digital asset that we want to hold, hoping number go up.
Yeah, exactly. It would be a tool to be able to go in and out of digital assets without having to then convert to dollars and back again.
Sure. So it's kind of like a bolt-on cash management account.
Exactly.
In your digital wallet.
Exactly. Yeah. So if someone had a whole lot of crypto and they were convinced that the market was going to drop, they might very quickly and easily swap all of that to a stable coin, and with the belief that that will stay at the value of a dollar.
Okay. So if we were to think about our dollars in our bank right now, that bank effectively is a custodian of this fiat or government money that sits inside of the account that they manage.
Yeah.
Whereas with a stable coin, how does that work? Like if I have, say, $10,000 worth of USDC or USDT, what does that actually mean and where is it?
The important difference is that being the token, you've got a lot more control over it, especially if you self-custody it in your own wallet. And if you're already involved in crypto, you probably already have that set up. And so apart from counterterrorism financing and other major things like that, those assets can't be kind of frozen or controlled. They're definitely yours. So you've got the freedom to do with those how you want. Right. Now, obviously, banking has a really important part to play in our society, but people might get nervous about the fact that there's been situations overseas where you say the wrong thing on social media and your bank accounts get frozen, or they might be concerned about fractional banking and people not actually being able to get those dollars back if they want them. But I think for most people, generally, they look at stable coins as a digital cash type of solution where they can send and pay overseas quickly and easily, as opposed to like a philosophical decision.
Right. But just going back to that, like if I was a Canadian trucker, which, one of those two things are true, then, and if I said something I shouldn't have, or supported a cause I shouldn't have, according to the government of the day, and I had a whole bunch of USDC in my digital wallet, you mentioned that with AML violations or counter financing of terrorism type thing, like how can they actually stop me from transacting in my stablecoins in my own digital wallet?
Gotcha. And this is probably a good way to talk about self-custody versus through a platform.
Sure.
So let's say the stablecoin was held by a custodial platform like Coinbase or any number of other kind of fintechs, exchanges. They could get a directive from local law enforcement or whatever, and those assets could be potentially frozen, right? That's one of the trade-offs for the convenience of that versus self-custodying. But when we're talking about freezing those assets, that is usually a very, very, very high standard. and it's Interpol or something like that going to the stablecoin issuer and saying, hey, we're going to freeze those tokens on the blockchain as opposed to a wallet, which is only done very, very rarely. And it's for trafficking of kids and stuff like that,
pretty extreme
as opposed
situations.
to posting something on social media.
Right.
Yeah.
So, but if I was self-custodying those stable coins on my own wallet, does that afford me any greater degree of freedom in terms of my transactions?
100%, almost complete freedom.
Okay.
And so you can think of, like, let's say another example of like CBDC, which we've talked a lot about before, central bank kind of digital currency, that you could think of it as being potentially like a stable coin, but with the surveillance and control directly from the government. Now, there are lots of models that don't have that, but that is the concern people have. And so if the whole idea is, but we need to have digital cash to interact with the digital economy, private stablecoins are already filling that gap pretty aggressively globally.
And so when you hold a stablecoin, the issuer has to have a dollar there, right?
Yeah.
And just talk me through like a little bit of history in terms of stablecoins and how you could get different things that back that dollar. But what is the, I guess, standard going forward in terms of what will generally always back a stablecoin?
Yeah, there's been experiments with algorithmic stablecoins where there's some kind of complicated maths,
jiggery-pokery.
They've typically always ended in tears because people try and manipulate it. There are still some very good kind of crypto-backed stablecoins where it's backed by a mixture of crypto, Bitcoin, things like that. They've always stuck around, but by far the most common model going forward is having one-to-one backed with cash and cash equivalents that are regulated or kind of controlled to have that trust layer. At the moment, different jurisdictions have a different take on what that licensing should look like. So the US has gone down a licensing route with the Genius Act, which we can talk about soon. Other regions, New Zealand as an example, have taken a more of an agnostic look where there's no special licensing for stablecoins, but it's more, the token is a claim on those dollars that are held in a bare trust with a bank. So there's that kind of legal protection there. Most stablecoins, including our two, there's no ability for everyday retail holders to then come back to us to swap the token for $1 and back again, because there's so much anti-money laundering risk and surface area there. So what we do is we have a smaller number of highly trusted, highly vetted wholesale counterparties that have very robust anti-money laundering kind of policies, and they are our trusted counterparties that can swap dollars for tokens and tokens for dollars, and they, with their users, it then kind of goes out into the wild and circulates. But there needs to always be trust in the market that if they needed to, those tokens could come back and be exchanged for dollars at 100 cents on the dollar. When that trust isn't there, or when it's broken, that's when things go downhill really, really quickly.
Okay. Because I guess there's trust in the institutional framework behind it.
Yeah.
And then there's trust in the actual underlying
technology.
Asset and the technology, but the asset behind it, right? So if it was US dollars or even short-term treasuries, for example, like dollar-like substitutes, that's very different to complicated algorithms and crypto assets that fluctuate and prone to manipulation.
Exactly. So if the underlying asset, everyone's confident that they could sell it in under a day and get it back into dollars, then generally everyone's pretty happy.
Okay.
And that's what short-term treasuries would do.
So July-ish last year, we saw the Genius Act pass into law. It was genius. I can't remember what it stands for, but maybe you could help me understand. What does it mean? Like, what does it actually do? Why should every country kind of go through that in some degree? I guess is my underlying question too.
Yeah, of course. I think the biggest impact it had was just tell the whole world that stablecoins are legitimate, they're not going anywhere, and that US is embracing them as part of their kind of economic plan, which is an amazing green traffic light for stablecoins around the world. It also had a kind of two-pronged strategic approach for the US, which was very beneficial. one, it repatriated all those issuers that had moved overseas because of the lack of regulation. So it's like, come back to America, we'll give you a really good framework to do it. You can bring back your corporate tax and your jobs and things as well, which is great. But really, really, really cleverly, it allows a large proportion of those reserves, those dollars that are held, to be held in US short-term treasury debt. So they were able to manufacture this whole other very sticky demand market to buy and hold US debt at a time where geopolitically, sometimes other countries are less excited about holding US debt. So very, very good move by them. Partly because of that, we have a market that is 99% of stablecoins are US dollar denominated. It's a huge industry, 300 billion at the moment is kind of the value of all the stablecoins in circulation. And volume, even when you clean out algorithmic trading and bots and things like that, it's still about 9 trillion a year in volume, which is several times bigger than PayPal. So it is a real thing. It's not going away. What I'm really passionate about is the idea of regions and non-USD stablecoins picking up their game to compete and interact with that economy, and not only to enable kind of really good products and services for people that live outside the US, but also for their nation's monetary sovereignty as well.
Okay, so I want to come back to that phrase monetary sovereignty in a second, but just going back to like the genius of all this, right?
Yeah,
it's creating demand for US debt, which is happening during a time where central banks in particular have been allocating more towards gold than they have to treasuries as their reserve assets, for potentially some good reason, right? They've seen what happened to Russia, perhaps. That was a bit of a clue as to what they should do. But it really feels quite interesting, because if you think about this, the petrodollar sort of arrangement that was arrived at in the 70s, where there was demand for US dollars because that was what would be traded for oil. Now it's like they've re-engineered that, reinvented that for the digital age, and saying, right, well, if you want stable coins, 99% of the market is ours, US dollar. But it's a fascinating bit of game theory, and it kind of makes me think that US dollar dominance isn't yet dead. Like in your view, do you think that this was about creating demand for US debt, or was this really genuinely just about being the leaders of innovation?
I think there's no doubt that the debt piece was a huge factor. And at the moment, you talk about central banks maybe not wanting to hold US debt. Of course, there's the pattern we've seen about freezing and controlling assets, but also the fact that essentially it's a way of exporting US inflation because they're the reserve currency, right? And then you look at the US, you look at their kind of debt, you look to a future where inflation is probably something that can continue to be a challenge for them. Maybe those countries don't want to be the place where that inflation is exported to. And at the moment, the status quo is with stablecoins. That's exactly what's going to happen, unless you get non-USD stablecoins rising up to meet the occasion.
Sure. Then they're effectively first mover advantage, right?
Yeah.
Where it's going to be really hard to compete with the likes of Circle and Tether to kind of get to that game.
Yes. Yeah.
And therefore, we're going to be, like, in a way, price takers, right? Like literally inflation takers.
Yeah.
Unless we do something, and each sovereign nation protect their own monetary sovereignty by creating their own digital stablecoin, right? Is that
100%? And if we take an example of that, New Zealand is like many other non-USD countries, where developed countries, where we have good monetary policy, we've got inflation basically under control for the most part. And the Reserve Bank is always looking at how can we preserve that monetary sovereignty in a future where Kiwis and, non-USD countries just by default use US dollar stablecoin. That's actually a real big problem for monetary sovereignty, right? So there's the economic incentive for people and businesses to be able to engage in digital markets with their own currency just for convenience. But then there's also the monetary sovereignty piece at a nation state level,
Yeah.
where you want those tokens to be backed by the local currency.
It's an interesting thing, because even amidst an OCR announcement, potentially as we speak in New Zealand, where the Reserve Bank of New Zealand is exerting its influence over the New Zealand economy by setting the price of money, it's a price control. There is an increasingly the suspicion that there's little regard for the local economy, and it's much more orchestrated internationally now via the BIS, for example. And probably about even just 6 months ago, that sounded conspiratorial, but now it kind of sounds like, well, that's probably how things work. And with stablecoins, I guess that's kind of, especially if it's dominated by the US, that's going to become more and more obvious that we're really just going along and riding on the coattails of whatever the dominant currency is.
Yeah.
He who controls the money controls the world.
Yeah.
So I know the Reserve Bank of New Zealand was quite keen on this whole central bank digital currency thing. It kind of feels like they've stepped off, which is kind of encouraging to see, considering some of the concerns that were aired at the time. But this is obviously going to be quite critical that they step up to it. Personally, I don't see a lot of initiative coming out of the Reserve Bank to kind of license stablecoin issuers. You're in the industry, though. How have they been? Have they been quite receptive? Like when you're dealing with regulators, are they quite keen?
New Zealand regulators are very receptive. It's one of the awesome things about innovating in New Zealand. The access to regulators and their general, openness to innovative solutions is fantastic. I think it's likely, and it's kind of our thesis, that at some point in the future, most developed countries will form some kind of stablecoin licensing regime. The US one has obviously set the standard. You've got Europe and MICA, which is a little bit more kind of controlling, and yet to be seen where Australia will go. There's some movement there, but everyone's in a holding pattern until the dust settles on that. So when you look at the Reserve Banks of New Zealand's goal to have digital currency, monetary sovereignty, and kind of global economic opportunities, then a private stablecoin that has guardrails to protect consumers kind of ticks all those things quite nicely without having the risk or the future risk of that kind of control and surveillance state that everyone gets nervous about with CBDCs.
Yeah. And now thinking a little bit about the banking industry a little bit, like here in New Zealand, we had a little bit of progress happening on the open banking space, and some fintechs will be taking full advantage of that, and we're probably going to see a whole slew of different offerings coming out soon, tracking your money and different payment service providers, and that's pretty cool to see that sort of stuff. With stable coins, how does that change the game? Does it make it kind of like a bad investment to worry about open banking? Like, was that all a waste of time when you could kind of just build an offering that's built around stable coins?
No, I think they're very, very complementary. Open banking is making the existing rails work so much better. And so apart from making sure the messaging is right, the trust structures remain, right? So that's a great, early step for so many use cases. So no problems there at all. Stable coins are almost like a completely different operating system. It's removing, if we think about traditional finance, you've got all these siloed parts to play, and it all kind of works, but it's all kind of clunky.
A lot of handshakes.
A lot of handshakes and a lot of kind of clipping of tickets and friction and things like that. But it works and it's safe and everyone believes in it. So that's a good thing. Stable coins and digital finance, the entire operating system starts from scratch. So you've got assets and money on the same ledger. So you've got, tokenized assets or digital currencies, whatever, and stable coins on the same operating system. They can settle instantly, atomically. So it's a huge change. So that's always going to be slower to get adopted. And it will typically be around the edges where even with open banking, there's still frictions like cross-border settlement, multi-currency, things like that. So that's where stablecoins can step in and solve some problems. And that's the only way new technology is really adopted, is it's got to solve problems an order of magnitude better than what the status quo is.
Right. I could be out of place here just by saying this, but I think most people in the financial services industry would still look at that term stablecoin and immediately think crypto, dangerous, Terra Luna, scam, Sam Bankman-Fried, I'm running.
Yeah.
Why is that not true though? Like why is it okay? Why is it safe to kind of innovate and think openly about stablecoins now, especially if you're in the fintech space?
Yeah, I think like most things, and I've made the mistake many times in my career, is trying to push and like evangelize technology change, and that only gets you so far. So it's really about determining where the really sticky pain points are that at the moment exist, and then offering a solution for that. Because people don't change their behavior because of a philosophy. They change it because it saves them dollars or time. And so, when you look at a stable coin, you've got kind of two elements of trust. Does the technology work? Well, we haven't had, the overall, the cryptography around tokens has stood the test of time. It's really been about the volatility and speculation behind it. So if you can trust the issuer, trust that they are regulated, trust that there is the appropriate reserve backing, then that allows you to then use those dollars out in the wild world as if it was a real dollar. And then you can start, it enables maybe smaller, maybe more agile Kiwi businesses to start to kind of compete on the global stage. Because at the moment, if they try to do that and they accept USD, US dollar stable coins, that's great. But then how do they actually get that into a medium where they can pay their lease, pay their bills? They need to then get that into New Zealand dollars. So without a good supply and a good liquidity with local USD, non-USD currencies, really regional entities are still priced out. They're kind of excluded from those markets because of the system behind holds them back.
So could you then say, just going back to the domination of the stablecoin market by US dollar denominated stablecoins, is it true to say then that different countries around the world, it's like it actually is in the best interest of the US to make sure that other countries develop their own stable coins as well, so that you have that kind of infrastructure that's being built out in those local economies that create that demand?
I think US will probably be quite happy if everyone just used the USD stable coins.
Of course,
It's in their best interest to perpetuate that.
Right.
It's in the best interest of the nation states, the individual consumers, and even more importantly, the corporations that are trying to compete globally to have a viable local alternative.
Interesting. I think we sometimes kind of separate the money and the state almost too much without realizing that actually, if you really do control the money, you really do control the world. Therefore, if you don't have sovereignty over your money, you don't really have sovereignty over your nation.
Yeah.
And so it is kind of like in a weird way, it's like a national security thing, isn't it?
Yeah, you could say that. And then yet we already see some countries have been really proactive in this. An example would be Nigeria. They've got their e-Naira. It's essentially a stable coin. And it's got huge uptake. And so the actual use of USD stablecoins in Nigeria is much lower than other African countries because they have a good local alternative.
Right.
So the playbook is there. It's just about whether that's something that is driven from the government point of view or whether it is done by private corporations or a mix of two. Maybe it's encouraged by government level, but driven by competitive private sector.
Sure. So at New Money then, you've launched, right?
Yeah.
But you don't have a licensing regime that you're operating within?
No, New Zealand doesn't have one. So
you don't need to abide by something that doesn't exist. That makes sense.
We've got a legal framework which we abide by, anti-money laundering and a compliance program that's a lot easier and manageable because we only deal with wholesale trusted counterparties for swapping dollars to tokens and vice versa. We don't have direct interaction with people, the public that want to swap, because that's just a whole nother money laundering surface area and risk.
Yeah.
But yeah, no, so we're live with the New Zealand dollar stablecoin, which is called DNZD, and the Australian one, which is DAUD.
Got it.
And yeah, so we're just going through the process of now building up the market making and the exchange listings that are now allow the distribution of those. We're really interested in helping Kiwi and Aussie companies compete globally in digital finance, whether it's payments, remittance, whatever, Forex.
Yeah, Forex would be a massive one, I would imagine.
Yeah, and Forex one is really interesting because the only, like, let's say a Kiwi business or an Aussie business or any regional, if they want to accept US dollars for payment, that's fine, because you know that you can swap US dollars to New Zealand dollars at any bank, very, very tight spreads. So we just need to try and replicate and bring that to the digital money, and so that people can accept US dollar stablecoins fine. They know that they can swap that to a local currency whenever they need to, and then back to the actual dollar with the issuer if they need to as well. That's that kind of velocity is how really, if we're going to make 2026 the year of the rise of the non-USD stablecoin, that's what needs to take place.
Right. So as a stablecoin issuer, what is the revenue model? Are you taking your revenue comes from spreads, or does it come from a mixture of spreads and just clipping the ticket on the reserves?
At the moment, we actually don't have any mint and redeem fees with our wholesale counterparties. All we do is the reserves that are held on trust, the interest from that, we keep that. We don't pass it on.
The revenue, and I guess the fact that you're not passing on any yield to token holders, you're no real threat to the banks right now, are you?
No, there's no, we're not competing for kind of deposit taking. And that was a big part of the Genius Act in the US, really, is that it prohibited stablecoin issuers from issuing a yield. Now, there are lots of ways for people with stablecoins, including ours, to be able to go to third parties and generate sometimes quite a competitive yield. Right. Like everything else in capital markets, the more the yield, the more the risk. So, do your own research as to how that yield is generated. There's no magic way to make yield. It needs to be made somehow. But by stablecoin issuers not being able to pass that on, some would have a view that that was the US banking interests kind of protecting that deposit taking function for the banks. And that might be true. There might be also some other structural reasons why it's good to keep those with banks. I'm not an expert on the US.
Right. Even just from like logistically how you would do that, if you had these one-to-one reserves and that money was held in some sort of bonds, short-term bonds, you were getting yield off that as the issuer. How would you transmit that yield to the holder of the token? Would you kind of like do airdrops?
There's a few different kind of models to do it. Sometimes it can be, I've seen models where you kind of lock up or stake some of your stablecoin and then the rewards go to that group. Others have like a rebasing model, which is basically of course, you don't want to increase the value of the token, otherwise it's not a dollar, right? Yeah, that's right. But it might be that you hold $100 of stablecoin, and then at the end of the year, you might look at, you got magically $110 in your wallet. So you can do that role as well. That I think the future where lots of stablecoins are yield bearing is probably not one that's going to happen anytime soon. Right. That'll be the last bastion of banks to hang on to. Then there might be good reasons. It doesn't really matter because there are more and more lower risk ways for people to choose your own adventure and get a yield in different ways.
Right. So we've seen JP Morgan coin seems to be there, like there's bank interests that are slowing things down already. Yeah. And is that primarily because the banks don't want to let go of this cash cow, which is holding all these deposits and paying pittance?
That's definitely going to be a factor. The other thing is with JP Morgan in particular, a classic example of look at what people are doing, not looking what they say. Years and years of anti-crypto sentiment, and then in the background forming teams to build it out. Yeah. So there's probably a mix, if I was to speculate, trying to protect the status quo, but also get ahead of the new world and get market share in that as well.
Got it. Okay. AI agents.
Yes.
So it seems increasingly like it's not going to be about businesses or even people that are out there doing stuff, holding money and earning money. It could just be these autonomous AI agents that are out there making little micro gains every now and then and storing them in Bitcoin maybe, and then using 1,000 different types of currencies to transact in all over the world doing whatever they do. Where does this go with stable coins? And do you see that these AI agents will create a significant demand for stable coins?
Oh, no doubt. I mean, we talked before about a single operating system. Well, now you've got intelligence and literal agents, literal code that would do what a hedge manager would do. And if they're able to get data and use money digitally, I mean, the world's your oyster, right? So there's all kinds of interesting things there, from replicating what happens off-chain now to entirely new things we haven't even thought about yet. In itself, agents don't necessarily expand the non-USD component. A USD coin could probably function, if you're doing trading, probably even better in some ways. What I'm excited about kind of agentic trading is arbitraging the Forex markets, because the Forex markets, huge, deep daily volume, very, very well established. If the premise is that a stable coin and this list of trusted stable coins are backed one-to-one, at the moment we have spreads and volatility still tight, but nowhere near as tight as off-chain Forex. So there is the opportunity for people to use bots to arbitrage differences in the exchange rate between digital and non-digital.
It breaks everything down into smaller units in a way, right? Like that opportunity shrinks tinier, but it moves so much faster.
Yeah.
And you're creating better liquidity because you're speeding up the velocity of money that's moving through the system.
Yeah, exactly.
I'm sure there's some downside risks there. If you put your doomer lens on, I'm sure that's pretty scary, thinking about these autonomous agents that are out there potentially paying people to do stuff, do the bidding. It's great, but I can also see that it's probably easier to regulate code than it is to regulate humans in terms of actually controlling their behavior.
That's definitely a part of it. I don't know about the regulation piece, but just a practical piece. The alternative is that bots would use credit card payments, right? Or you give it access to your bank account. Probably pretty bad ideas. The credit one, just because you're losing so much in the spreads with the transaction fees. So let's say you develop this new agent. You're like, yep, this is pretty cool. I'll put $10 of stablecoin in this wallet. You can never go negative in that. Unless you're doing margin or something really creative, it'd be really hard to go negative in that. And it's a wallet, right? It's not attached to a person. So I'm not actually sure how you could go negative. You could just abandon the wallet.
Yeah.
So again, looking at stablecoins, instead of being a product in itself, wow, a shiny stablecoin, it's like, cool, this is digital money. What cool stuff can we do with it?
The ecosystem that starts to evolve around it, that is the thing to watch, not necessarily the boring thing.
Exactly.
It's just water, right?
Yeah.
But it's the ecosystem that it supports.
And so what an ideal outcome, I think, for stablecoins in general, and more specifically non-USD ones, is that maybe a couple of years from now, someone like my mum who has no interest in crypto might open up her new wallet on Facebook or whatever it is, and there's dollars there, and she's buying and spending and buying gifts and sending money overseas. And behind that, it's actually stable coins that are doing the cool stuff, but it's all abstracted away to make it really simple and easy. Yeah. That would be the ideal situation, because we don't want to try and...
We're looking underneath the bonnet here, right? Like there's so much technical stuff going on here. Yeah. We're having this conversation. People don't really need to understand it because it's not really... No, you don't need to know this
compression,
stuff,
audio compression formats. Who cares? We're having a conversation. People can hear it.
Yeah, exactly.
Yeah.
So, okay. With new money, tell me about the roadmap. What's next on the horizon? What's your biggest pain point? What are you excited about in terms of your next milestone?
Our initial friction was getting the banking and all the legal framework set up. It's always tough to be on the fringe of what's happening because you're kind of pushing the envelope. So luckily we've got smart people around us that have got us to this point. Issuing the stable coins was kind of that milestone. Now the next thing is, of course, you're going to a company who might want to use them. They want to ask, how easy is it for me to get from your stable coin to a US dollar one, right? What is that liquidity like? And so that has forced us to find a very good, reputable market maker, who I won't name, but we're going through the process of getting both of our stable coins supported by them. So that will be deep liquidity options for people to use. And then that unlocks exchange listings, other kind of corporate institutional use cases that solving those problems of moving money cross-border and things like that. Yeah. I would love to see a day 12, 24 months from now where generally everyday people are using it in their life to buy stuff and to send money. And they could do that now, but it needs to become more embedded into easier user interfaces. Sure. At the moment, if someone's a crypto enthusiast and they wanted to do that, they can, and people do that. But if we come back to like my mum as the target demographic, how would she use stablecoin? Well, it needs to be super simple, super easy, and it just needs to work. One of the ones that caught my eye the other day, it's an overseas company, but they're looking at payroll solutions with stablecoin, because suddenly, instead of doing payroll once every 2 weeks or once every month, it could be done theoretically every day, every hour, really. And it could be automated so much more than payroll often is. Yeah. Cross-border instantly, great for people with global teams. Yeah. So that's just a very, very small example of what digital money unlocks. Yeah.
I'm sure it'll be like really obvious in the future when we look back at this, right? Yeah. I just did a trade on TradeMe recently. I sold something on TradeMe and the buyer didn't go through, partly because there was a big gap between when the trade was initiated and when settlement actually occurred, or in this case, didn't occur. If it was all instantaneous, no problem whatsoever, yeah. Right? So in a situation where you were buying a car off someone, you're even buying a house for that matter, yep. How could stablecoins and other types of technology, specifically smart contracts, how could that make that whole process of exchanging funds for large items go really smoothly?
So whether you're talking about an auction or you're talking about a big trade deal with millions of dollars, or it's staged kind of contract, payments, yeah. Freelancing, things like that, yeah. Because you've got this single ledger that can hold the money and kind of escrow those funds in a smart contract, you could quite simply actually have an auction platform where before you actually sign to say, yep, I'm going to bid, I'm going to accept it, you have to have those funds locked in escrow. And then, the one is a blockchain and atomic settlement. Either both sides happen or no sides happen. So you've got no chance where you send the money, then don't get what you want. It can happen atomically. So that's another example of how that could work. And that's where I see lots of opportunities with trade. At the moment, that happens through trust accounts with the SWIFT network. So it could be stable coins with a smart contract, but it could just be the same trust structures, but just the money gets sent in a second instead of, 24, yeah. How many hours it takes or over the weekend and stuff like that.
Okay. Property. What can you tell me about where things are at with tokenization of real estate?
Yeah.
And how does, and maybe it does, maybe it doesn't, but how does stablecoins perhaps help in that transaction?
So there's kind of two really cool opportunities for stablecoins with tokenized assets, whether it's property, tokenized equities, whatever. By having the asset and the money on the same ledger, it means you can settle instantly and atomically. So,
So when you say it's on the same ledger, like say with property, for example, the title itself will be tokenized and put yep. on that ledger next to the money itself used to trade those things together, right? Is that what you mean?
Exactly. So whether it's title-backed tokens, which are kind of the newest evolution, or whether they are just kind of more traditional tokenized equity in a company that holds no matter what the underlying asset is, or the legal structure of it, the fact that it's represented as a token means it can move at the same speed that a stablecoin can. So you've got really clean settlement, right? So that's the first one. The second one is if you've got any yield-bearing component to the asset. So for title-backed tokens, for example, which we also work on under the Toroa kind of umbrella, you've got the how do you rent share proportionate to how much of the title that person holds. Well, that's where we're using, it's a great utility for our stablecoin, right? So we can distribute, if there's a big commercial building and it's broken into how many title-backed tokens, the proportion of that net revenue each month can be distributed to token holders, and it's just there in their wallet.
Right.
So that means two things: super, super clean, easy. It makes the title-backed token more valuable because it's getting really clean, fast revenue coming in. That's got the provenance of blockchain. You can see the transparency of how it's happened. It also means that the efficiencies of scale go all the way down to basically arbitrary. There's no difference in terms of fees or speed, whether you're sending $1 stablecoin or $1 billion in stablecoin. There is no difference in speed or fees.
Which is going to be it's going to be so disruptive to so many industries, and property in particular, right?
Yeah.
I can think of mortgages. I can think of like real estate agents, lawyers to a certain extent. A lot of them are going to be disintermediated with this because it's all going to be settled atomically, and there's no sliding revenue based on the value of the underlying asset that's trading hands, right?
Yeah, and if we look to history, there will be some lawyers, some real estate developers that get on early. They've got the trust factor. People, we're emotional creatures. We like to trust someone. We want to have a real person. We can go and knock on the door if something goes wrong. It'll be the early adopters of that technology that do the market share, rather than kind of an abstract faceless protocol that I'm not going to trust my house to some faceless thing. But if it's a company that I already know and trust, and they are able to offer me a product or service that's better, faster, cheaper, that's where the economic value is going.
You can totally see AI agents replacing real estate agents as well, right? Where instead of you're actually putting it to an external person and they're trying to reach whoever the buyers are out there in the ether, you have this agent who's actively and proactively reaching people who are in the market for that exact property. But instead of just selling that asset, they're actually completing the settlement and organizing everything, right? In terms of the title and all that sort of stuff.
Yeah. And it might be that the full settlement always ends up in traditional rails because you do it once a decade and it's a couple $1 million. But then what about all those other layers of services and products and things like that that can be arbitraged? That's an interesting one.
Yeah, it is. Okay. Where can people go to learn more about new money or DNZD, DAUD?
Best way is to go to our website, www.getnew.money.
Getnew.money. Okay, that's good. Thank you very much, Ryan Johnson Hunt, for coming on the podcast again. Appreciate it.
Awesome. Thanks, Darcy.
Special thank you to our show partners who helped make this possible. Thank you so much. You're awesome. SwiftX and Provincia. Thank you again. Want to connect on social media? You can find me on X and you can find me on LinkedIn. Remember, some investment strategies or ideas can make you obscenely wealthy or wipe you out completely. It's hard to know from this end what's best for your world. So if you can, reach out for some advice that accounts for your own circumstances. That's it for this one. Catch you next time. I'm out.